Algorithmic trading has grown across asset classes. You can see that whether we're talking about the equities and futures and options and so on. It is in fact the case that algorithms are trading the market. And what does that mean? A lot of people don't really understand. Well, you have computer programs. So you get an individual that works in the financial industry, sits down with those in the tech side, the programmers, and they say, look, we have to figure out a way to be able to trade these markets. So when it works like this, this is what you're going to do. And it does this, you're going to do this. And they program that in. So you have some human sort of interaction meeting with a programmer who then puts that into a digital means. And then that is traded here at a faster speed than any one of you or I couldn't trade. It is literally impossible for you to trade faster than these machines. They are so fast physically, as well as their network speed is faster. So what they can do is, in fact, this is the way it works. They can see that you're making a trade. They can see that, go in front of you, buy it up at that price, sell it back to you more expensive. That's how lightning fast their trades are. That's a monopoly because they're just trading at like nanoseconds, coming in and buying, selling, and making these small percentage dollars or whatever it is, making that small amount of money, but doing it millions and millions and millions of times a day. And suddenly they're making a fortune. They make it on the way up. They make it on the way down. They decide what happens. That is algorithmic trading, okay? And all of the markets today are trading based on that. I've seen statistics here. I don't necessarily know where they're pulling their stats from, but I've seen almost 100% of the trades that go on today are done by algorithms, by computers, not done by humans. I've seen the trading floors before and they are active. There are people there. I know about this very personally. However, how is it the case that you have most of the trades going on by computers? Because slowly but surely these traders are being pushed out of the job and they're going on to do that themselves. They're just day trading on their own because it is going to be a dying industry for humans to do it. And regions through the US still leads the way. Market share of algorithm trading by the region. Look, US is number one very clearly. Europe is secondary to that. All right. Algorithmic trading has become more popular across products within futures markets, whether we're looking at commodities and you know, anything here they show you on the list. It is in fact becoming more popular as time goes on. This is going from 2013 and 2014 up to 2015, 2016, those years there, and clearly in every way basically we've seen those rapidly being increasing. Now, Amazon insider transactions have been going up over the recent little while here. Other than a few instances, we will see that, yes, in fact, they're constantly going through this, trying to buy up their own shares. So what they do is, let me briefly break it down. So we have the case of a share buyback that's going to occur. They know that that boosts the price substantially, okay? Every time they do it, they buy back shares, it boosts the price. So what do you do? Well, all you need to do is go in. This is crazy, but this is what they do. They go in, they decide at this moment whether they will buy more shares before that, or they will wait till the price boosts up and then sell some shares. So it depends on what they want to do. If they want to load up or they want to sell off. And a lot of times it is actually in selling off mode. This is not just Amazon. In fact, this is for most of the companies out there. I saw a list of them, but I just wanted to pull up Amazon. That's what's happening. You know, insider trading is going on all the time, and it is in fact allowed to happen. Not for you and I, but for the big boys. On PPP terms, China is already the biggest economy in the world. I was really shocked to see that, the way that works. Of course, that's on the purchasing power parity. We're not talking about just dollar terms, for example. Then that's not the case, okay? But we're looking at it versus, you know, the purchasing power parity, how that is different than on US dollars. right? So you could see that the US would be in second place in that case, and how that is very different from what we see on the very left there with China. In US dollar terms, significantly lower, but still very, very large. I mean, we need to understand that. And then on the right-hand side, China's contribution to global real GDP growth. This has definitely changed over the years as the GDP has declined, but at least they're willing to admit that their GDP is declining instead of other areas around the world where it is declining and somehow they're showing us 5% and other ridiculous numbers. Okay, the 10-year change in private sector debt to GDP in China has been comparable to previous changes in Thailand and Spain prior to their crisis. And you'll see that comparing here throughout these different time periods, different eras. Right here basically is China, and we are comparing that to Spain 2000 to 2010 and Thailand from 87 to 97. I hope you read about what happened with Thailand back during those years. In fact, how so much hot money had been going into this country. They couldn't stop it. It was just insane what happened, and they were completely destroyed for a period of time. Okay, so they're just comparing those two. Credit to GDP is now 12.6 percentage points above the trend. Looking at that with China specifically, they have been engaging in a lot of different methods in order to support their economy and the stock markets as well. We're talking about everything from the People's Bank of China going in printing up money directly. They are using subsidiary corporations to be there to buy up all the garbage. They are loosening their lending restrictions, making it very, very easy. They are also doing, the reserve requirement ratios. They are making that easier as well. So the banks need to hold less money. The investment institutions are allowed to gamble even further. Now I want to connect this in with a different issue. Now, all of this is going to come to a head at some point, and we're going to have major problems with pension funds and retirement accounts in general. And a lot of people are relying on this, but it goes even further than that. So I found this article out of Bloomberg, and I thought it was amazing, and I wanted to bring it to you. Rich kids are counting on inheritance to pay for retirement. I couldn't believe that when I read it first, but then I thought to myself, that's what a lot of people do. They're relying on their parents to basically be able to continue on with their lifestyle. And whether that is a very lavish lifestyle or not, it's simply the case. They're spending money all the way as much as they can in order to basically say, well, I'm going to have some money coming to me, so no need to worry. And they also do the same thing for real estate. For example, if that person had a house or even, let's say, a cottage or some sort of vacation home, they're thinking, I'm going to be able to sell that one day. I'm going to take the money and I'm going to be able to continue on living. Or they have a business where they're buying real estate, or their parents own a business of some sort, and they'll think that's money coming to me. Well, I don't know about you. I'm not getting anything in order to, any sort of business or anything like this, and I'm not relying on anything, okay? I don't ever expect any money coming my way that I didn't earn with my own two hands. That's the way it's got to be. That's how it happens. A lot of people, they get the lottery, they win 50 million and they blow it all. They win 100 million, they blow it all. It doesn't matter how much, they're going to waste it all. They don't know what to do with the money. They end up giving it to the wrong people, the wrong institutions, and unfortunately, they lose every penny. Most of the cases, actually, they end up worse off. They say, I wish I would have ripped up that check. That's how crazy this really is. At first glance, it may look like brazen entitlement. 63% of affluent children between the ages of 18 and 22 say financial stability in retirement will depend on inheriting money, as in the money their parents spend a lifetime accumulating or given increasing income inequality inherited themselves. Before you start growling, consider this may be a signal of desperation. Agreed, the rise in student debt, increased life expectancy, and the many competing priorities for money that are considered the new normal for younger generations have them wondering how they will pay for it all. And that's what I think is the case with a lot of people. They don't know what to do with money, and unfortunately they just need more coming in. That's all they realize. Well, you need to get your mind right. You need to do that, and that's what this channel is all about. Being able to understand the information not taught to you during the education system. That's why I wrote my books. The role of inheritance in retirement plans. A global survey found 11% of American workers factored an inheritance into retirement planning. That compared with 7% for Japanese workers. You could see that India on the right-hand side, going through the middle of that being the US and the UK, and there a lot of people are simply relying on money coming their way or different retirement accounts. Okay, so we're talking about the RRSPs, we're talking about the 401ks, all the different pension funds. All of that's going to be gone one day, and people think for a second, well, I paid into it, so of course I'm going to deserve that. Well, it's really in somebody else's hands at this point. Great expectations for inheritance. Gen Z, kids between 18 and 22, are most likely to say they'll rely on their inheritance for retirement. Only 20% of baby boomers said that. Of course, they're not worried about this. They are simply making ends meet. They're doing what they can. But when you're 18 and 22, I really don't think they're necessarily caring about retirement when you're 18 or 22 years old, okay? But at the same time, what are you going to do today to make that money? What are you going to do today to prepare for what's coming? A lot of people don't realize it, but that's all. I'm going to end it there. This video went way too long. It's probably going to be split into two, but regardless, if you found it informative, please give me a thumbs up. When you give me a thumbs up, it helps to support the channel. I do appreciate that. And if you want the financial education that was not taught to you in schools, well, these two books have it all. I wrote these two books specifically with the average person in mind. Whether you know a lot about the financial industry or know absolutely nothing, these books they just break down everything. They go from A to Z. They really cover everything you need to know to get that foundation, to make money, the 4 asset classes, self-sufficiency, and everything. They fit into each other like puzzle pieces, so they're both very useful for their own things. You know, they do cover familiar topics, but it's, you know, they tend to, as I said, fit in the puzzle pieces for each other. It is the way I wrote them on purpose. And this is also available in the audiobook version at themoneygps.com. Take care.